Attention seniors, starting January 1st, 2027, a major change to Social Security taxation could mean you've been overpaying for years without knowing it. Last Tuesday, a 71-year-old woman named Dorothy from Mesa, Arizona, opened her mailbox and found a letter that changed everything. She'd been paying taxes on her Social Security benefits for 6 straight years when she didn't have to. Her hands trembled as she calculated the total, $4,247 taken from her when she qualified for an exemption the entire time. She sat at her kitchen table for an hour, unable to move, realizing how much that money would have meant for her prescriptions and groceries. Real quick before we continue, a subscriber named Robert emailed me last week saying this channel saved him $12,000 in 1 year, but only because he subscribed and got notified when new videos came out. If you're not subscribed, you're going to miss the next urgent update. Click that subscribe button right now. Let me tell you about Helen. She is 73 years old and lives in Dayton, Ohio. She worked as a nurse for 42 years and retired in 2019 with what she thought was a solid plan. Her Social Security check was $1,890 per month, and she had a small pension of $640. She'd been filing her taxes every year like clockwork, paying what she thought she owed. For 5 years, she paid federal taxes on 85% of her Social Security benefits without questioning it. Last September, Helen's neighbor mentioned something at their community center meeting. The neighbor said her accountant told her that many seniors qualify for tax breaks on Social Security that nobody tells them about. Helen felt her stomach drop because she'd never heard this from anyone. That night, she couldn't sleep. She got up at 3 a.m. and started searching online, trying to understand what she might have missed. The next morning, she called a tax attorney who reviewed her returns from the past 6 years. Here's what the attorney discovered. Helen's combined income put her right at the threshold where she could have reduced her taxable Social Security benefits significantly. Because of certain deductions she never claimed and a formula she didn't know existed, she'd overpaid by $3,147 over those 6 years. The IRS had that money and she had no idea she could get it back. The attorney explained that the 2027 rule change would make this even more important because the thresholds were shifting. Helen had exactly 90 days to file amended returns for the most recent 3 years. If she missed that window, she'd lose the right to claim $2,100 of that money forever. Helen took action immediately. She hired the attorney to file the amended returns and submitted Form 1040X for 2023, 2022, and 2021. Within 4 months, she received a check from the IRS for $2,180. She told me last week that she cried when she opened that envelope. Now she's working on understanding the new 2027 rules, so she never overpays again. She said the hardest part was knowing how many of her friends were probably in the same situation and had no idea. Here's what makes me angry about Helen's story. She did everything right. She worked her entire adult life, paid into Social Security faithfully, and filed her taxes honestly every single year. Nobody at the Social Security office told her about these thresholds. Nobody at the IRS sent her a letter saying she might qualify for a reduction. The system took her money and stayed quiet. How many other seniors are sitting in the exact same position right now, overpaying because they don't know the rules? Now let me tell you about James. He is 68 years old and lives in Clearwater, Florida. James retired from the post office in 2020 after 38 years of service. His Social Security benefit is $2,150 per month, and he also gets a federal pension of $890 per month. He thought he understood his tax situation because he'd been dealing with it for 4 years already. Every April, he filed his return, paid what TurboTax told him to pay, and moved on with his life. In November of last year, James attended a free seminar at his local library about retirement planning. The speaker was a CPA who specialized in senior tax issues. During the presentation, the CPA mentioned something called provisional income and how it determines Social Security taxation. James had never heard that term in his life. The CPA explained that many seniors miscalculate this number and end up paying more than required. James felt his face get hot because he realized he might be one of those people. The very next day, James made an appointment with that CPA. He brought 6 years of tax returns with him to the meeting. The CPA spent 2 hours going through every single return, line by line, checking the calculations. What she found made James sick to his stomach. He'd been calculating his provisional income incorrectly every single year since he retired. Because of how his pension was categorized and certain exclusions he didn't apply, he'd overpaid federal taxes on his Social Security by $4,680 over 6 years. That was $780 per year, gone, money he'd worked his entire life to earn. But here's the catch. The CPA told James about the 3-year limit for amended returns. He could only get back the overpayments from 2023, 2022, and 2021. The money from 2020, 2019, and 2018 was gone forever because he'd missed the window. That was $2,340 he could never recover. James filed the amended returns for the 3 eligible years and received $2,340 back from the IRS in March. He saved that check stub and keeps it in his desk drawer to remind himself to stay informed. He told me he thinks about that lost $2,340 almost every day, and it eats at him. Stop. Listen to this. The 2027 change James's CPA warned him about is real, and it's coming fast. Right now, the income thresholds that determine Social Security taxation haven't changed since 1984. That's 43 years of inflation with no adjustment to the thresholds. Starting in 2027, new rules go into effect that could change who pays taxes on benefits and how much they pay. If you don't understand these rules before they hit, you could end up like James, losing thousands because you missed the window to fix it. Quick question before we continue. What state are you in? I need you to comment your state name right now. The rules I'm covering change by state, and I read every single comment. Plus, your comment helps other people in your state find this video. Drop your state in the comments right now. Let me tell you about Barbara. She is 69 years old and lives in Scottsdale, Arizona. Barbara worked as an elementary school teacher for 35 years before retiring in 2018. She receives $1,145 per month from Social Security and $520 per month from her state pension. Barbara always considered herself financially savvy because she managed the family budget for decades. When her husband passed away in 2016, she took over all the financial decisions and thought she had everything under control. In March of this year, Barbara's daughter came to visit from California. Her daughter works as a paralegal at a law firm that handles elder law cases. During dinner one night, the daughter mentioned that her firm had been getting calls from seniors who discovered they'd been overpaying Social Security taxes for years. Barbara laughed it off at first, saying she used H&R Block every year, so her taxes were definitely correct. But her daughter insisted she at least get a second opinion from someone who specialized in this exact issue. Barbara agreed just to make her daughter stop worrying. She contacted a tax attorney in May and sent over her returns from the past 5 years. 3 weeks later, the attorney called her with news that made her hands shake. Barbara had been paying taxes on 85% of her Social Security benefits, when her actual income level meant she should have been paying on only 50% of her benefits. The difference was huge. Over 5 years, she'd overpaid by $5,120. The attorney explained that because of how her pension was reported and some investment income she had, the calculation was more complex than basic tax software could handle. Barbara felt betrayed by the system and angry at herself for not catching it sooner. Here's where Barbara's story gets worse. The attorney filed amended returns for 2023, 2022, and 2021 immediately. Barbara got back $3,180 from those 3 years. But the $140 from 2020 and 2019 was lost forever because the 3-year statute of limitations had already passed. Barbara told me she lies awake some nights thinking about what she could have done with that extra $1,940. It would have covered her Medicare supplement premiums for an entire year. The money was hers, she earned it, and now it's gone because nobody told her to look closer at her returns. Now here's the good news. Barbara is now preparing for the 2027 changes. The attorney explained that the new rules could actually work in her favor if she understands them and plans accordingly. Barbara adjusted her withholding, changed how she takes distributions from her retirement accounts, and set up a system to review everything annually. She won't make the same mistake twice. She also shared this information with 6 friends from her church, and 4 of them discovered they'd been overpaying too. Let me tell you about Michael. He is 74 years old and lives in Tulsa, Oklahoma. Michael owned a small plumbing business for 40 years before selling it and retiring in 2017. He gets $2,340 per month from Social Security, and he sold some rental properties in 2019 that still generate about $800 per month in carried payments. Michael thought he was being smart by working with the same accountant he'd used for his business for 20 years. That accountant handled his business taxes just fine, but apparently didn't specialize in retirement taxation. One afternoon in January, Michael was having coffee with his brother, who lives in Kansas. His brother mentioned that he'd just gotten a $20,600 refund from the IRS after filing amended returns. Michael was confused because his brother's financial situation was almost identical to his own. His brother explained that a tax attorney reviewed his returns and found that he'd been overpaying taxes on Social Security because the accountant used the wrong worksheet. Michael felt his chest tighten. He'd been using the same accountant and probably had the same problem. Michael called a tax attorney the next week. He brought in 7 years of returns because he wanted everything checked. The attorney's findings were devastating. Michael had been overpaying federal taxes on his Social Security benefits by an average of $920 per year since 2017. That was a total of $6,440 over 7 years. The attorney explained that the accountant had been using a simplified calculation that worked for most people, but didn't account for Michael's specific income sources. The carried payments from his property sales needed to be treated differently in the provisional income calculation, and the accountant had missed that detail entirely. But here's the tragedy. Michael could only recover 3 years of overpayments. He filed amended returns for 2023, 2022, and 2021 and received $2,160 back from the IRS. The other 4 years, totaling $3,680, were beyond the 3-year limit and completely unrecoverable. Michael fired his accountant immediately and now works exclusively with a tax attorney who specializes in retirement taxation. He told me he feels stupid for trusting someone who wasn't qualified for his specific situation. That lost $3,680 haunts him because it was his money, and it's gone forever because of someone else's incompetence. Here's what makes this worse. Michael's situation is happening to thousands of seniors right now. They're using general accountants or tax software that doesn't understand the complexity of Social Security taxation. The calculations look simple on the surface, but there are dozens of variables that affect the final number. If you get even one variable wrong, you overpay, and the IRS will happily take your money without ever telling you that you paid too much. They don't send you letters saying you overpaid. You have to catch it yourself or it's gone forever. Wait, this is important. The 2027 rule changes are going to make these calculations even more complex. New thresholds mean new formulas. If you're not working with someone who understands Social Security taxation specifically, you're gambling with your money. Every single year you overpay is money you can't get back after 3 years. Think about what you could do with an extra $800 or $200 per year. That's real money. That's groceries, medication, utilities, things that matter in your daily life. If this information is helping you right now, I need you to do something. Hit the like button on this video. Here's why that matters. The more likes this gets, the more YouTube shows it to other people who need this information. It takes literally 2 seconds. Do it right now while you're thinking about it. Let me explain what's actually happening with Social Security taxation. Right now, you pay federal income tax on your Social Security benefits based on something called provisional income. This isn't your adjusted gross income, and it's not your total income. It's a specific calculation that most people get wrong. Provisional income equals your adjusted gross income plus tax-exempt interest plus 1/2 of your Social Security benefits. Once you calculate that number, you compare it to 2 threshold amounts. If you're single and your provisional income is less than $25,000, you pay 0 federal tax on Social Security. If it's between $25,000 and $34,000, you pay tax on up to 50% of your benefits. If it's over $34,000, you pay tax on up to 85% of your benefits. For married couples filing jointly, the thresholds are $32,000 and $44,000. These numbers haven't changed since 1984 when they were first set into law. Inflation has made these thresholds completely outdated. Here's what most people miss. The calculation includes tax-exempt interest from municipal bonds. Most tax software asks about this, but many seniors don't realize their municipal bond interest counts toward the provisional income calculation. That one mistake can push you into a higher taxation bracket without you realizing it. Another common error involves pension income categorization. Depending on the source of your pension and how it's reported, it might affect your calculation differently than you think. These technical details cost people thousands of dollars every year. Now here's where 2027 comes in. Congress has been under pressure for years to adjust these outdated thresholds. Starting in 2027, new legislation changes how provisional income is calculated and adjusts the threshold amounts for inflation. The details are still being finalized, but early reports suggest the thresholds could increase by 40% to 60%. That means many seniors who are currently paying taxes on 85% of their benefits might drop down to 50% or even zero taxation. But you have to understand the new rules and plan accordingly. Don't skip this. If you've been overpaying taxes on Social Security under the current rules, you need to file amended returns now before the 3-year window closes. Every month that passes is another month of potential recovery slipping away. If you overpaid in 2021, you have until April 15, 2025 to file an amended return for that year. After that date, that money is gone forever. You can't get it back, no matter what. The law is absolute on this point. Let me tell you about Patricia. She is 70 years old and lives in Boise, Idaho. Patricia worked as a dental hygienist for 33 years before retiring in 2019. She receives $1,680 per month from Social Security and has a small 401k that she takes $500 per month from for extra expenses. Patricia used TurboTax every year because it seemed simple enough and she didn't want to pay for an accountant. For 4 years, she filed her returns, paid what the software calculated, and never questioned whether it was correct. In April of this year, Patricia's son came to visit for Easter. Her son is a financial advisor in Colorado, and he asked to look at her tax returns just to make sure everything was being handled correctly. Patricia gave him the last 4 years of returns, thinking he'd tell her everything looked fine. Instead, her son spent 2 hours at her kitchen table with a calculator and a very concerned look on his face. Finally, he told her she'd been overpaying her federal taxes by about $740 per year because TurboTax had miscalculated her provisional income. Patricia felt her heart sink. That was $2,160 over 4 years, just gone. Her son explained that the software had incorrectly categorized some of her 401k distributions in a way that inflated her provisional income calculation. It was a technical error that the software made because it couldn't account for the specific type of 401k plan she had. Her son helped her file amended returns for 2023, 2022, and 2021 that same week. Within 3 months, Patricia received a check from the IRS for $2,220. But the $740 from 2020 was lost because the 3-year statute had already expired in April. Patricia told me she now has her son review her returns every year before she files them. She also switched to working with a CPA who specializes in retirement taxation. She said the peace of mind is worth every penny of the CPA's fee. She knows she's not overpaying anymore, and she understands how the 2027 changes will affect her specifically. Her son created a plan for her to optimize her 401k distributions starting in 2026, so that when the new rules take effect, she'll pay the absolute minimum tax legally required on her Social Security benefits. Think about someone you know who needs to hear this. Your mom, your dad, your neighbor, your friend from church, someone who could lose money if they don't know what I just explained. Share this video with them right now. Copy the link, text it to them, email it, however you communicate. Do it now before you forget. This information is too important to keep to yourself. Here's what you need to understand about the 3-year rule. The IRS allows you to file an amended return using Form 1040X for any return within 3 years of the original filing deadline. For most people, that means you have 3 years from April 15th of the year after you earn the income. So if you filed your 2021 taxes in April 2022, you have until April 15th, 2025 to amend that return. After that date, it's over. The IRS will not accept your amended return and you cannot recover that overpayment. This 3-year rule is not negotiable. It doesn't matter if you have a good reason for missing it. It doesn't matter if you didn't know about the error. It doesn't matter if the mistake wasn't your fault. The law says 3 years and that's it. Right now in February 2026, you can still amend returns for 2023, 2022, and 2021. The 2020 window closed in April 2024. The 2021 window closes in April 2025. Time is literally running out for 2021 overpayments right now. Here's what makes me angry. The IRS knows that most taxpayers overpay. They have the data. They can see when someone calculates provisional income incorrectly, but they have no legal obligation to tell you that you overpaid. They'll send you a letter immediately if you underpay, demanding money plus interest and penalties. But if you overpay, they stay silent and keep your money. The burden is entirely on you to catch the error and file an amended return within 3 years. It's a one-way system designed to benefit the government. Pay attention to this next part. The 2027 rule changes create a unique opportunity. If you've been overpaying under the old thresholds, you need to recover that money now before the window closes. Once the new rules take effect in 2027, the old overpayments become even more frustrating because you'll realize you were paying under an unfair system. Don't wait until 2027 to look back and regret not taking action now. Every senior I've talked to who recovered overpayments said the same thing. They wish they'd done it sooner. Let me tell you about William. He is 72 years old and lives in Charleston, South Carolina. William retired from a career in banking in 2018. He receives $2,190 per month from Social Security and has investment income of about $1,200 per month from a diversified portfolio. William always hired a CPA to do his taxes because he wanted professional handling of his investments. He trusted his CPA completely because the firm had been around for 30 years and had a good reputation. Last August, William attended a retirement planning workshop at his country club. The speaker was a tax attorney who specialized in helping seniors optimize their tax situations. During the Q&A session, someone asked about Social Security taxation, and the attorney mentioned that many CPAs get the calculation wrong because they don't specialize in retirement taxation. William felt a knot form in his stomach. After the presentation, he approached the attorney privately and asked if she'd be willing to review his last 5 years of returns. The attorney's review took 3 weeks. When she called William with the results, he had to sit down. His CPA had been miscalculating his provisional income for 5 straight years because of how the investment income was being categorized. The error was costing him $1,140 per year in overpaid federal taxes. Over 5 years, that was $5,700 of his money sitting with the IRS. William immediately confronted his CPA, who admitted the error but said there was nothing that could be done about it. The CPA was wrong about that too. William hired the tax attorney immediately. She filed amended returns for 2023, 2022, and 2021, recovering $3,120. But the overpayments from 2020 and 2019, totaling $2,280, were beyond the 3-year statute and permanently lost. William sued his former CPA for malpractice and settled out of court for the $2,280 he couldn't recover from the IRS. The entire process took 14 months and caused William tremendous stress. He told me he'll never trust a general CPA with retirement taxation again. Now he works exclusively with tax attorneys who specialize in seniors and Social Security. Here's exactly what you need to do right now. I'm going to give you 5 steps. Each one is simple and specific. You don't have to do everything today, but you need to start with step 1 this week. Write these down or save this video. Ready? Let's go through them. Step 1. Gather your tax returns for 2023, 2022, and 2021 right now. Go to your filing cabinet or wherever you keep important documents and pull out those 3 returns. If you don't have physical copies, log into your IRS account at irs.gov and download them. You need the complete returns, not just the 1040 summary page. Look specifically for the worksheet where Social Security benefits taxation was calculated. That's usually on a separate worksheet or in the tax software printout. Do this today before you forget. Having these documents ready is the first step to discovering if you've been overpaying. Step 2. Calculate your provisional income for each year manually. Don't trust what the tax software or your accountant calculated. Do it yourself using the IRS formula. Take your adjusted gross income, add any tax-exempt interest, then add 1/2 of your Social Security benefits. Write down that total for each year. Then compare that number to the thresholds: $25,000 and $34,000 for single filers, $32,000 and $44,000 for married filing jointly. If your number is close to either threshold, you're in a danger zone where small errors can cost you hundreds or thousands of dollars. Do this calculation by Friday this week. Step 3. Contact a tax attorney or CPA who specializes specifically in retirement taxation and Social Security benefits. Not a general accountant, not your nephew who does taxes part-time, but someone who does this specific work every day. You can find them by searching retirement tax attorney, plus your city name, or Social Security taxation CPA, plus your state. Interview them before hiring and ask how many Social Security tax reviews they've done in the past year. If the number is less than 50, find someone else. Schedule a consultation for next week and bring those 3 years of returns with you. Step 4. If the specialist finds overpayments, file amended returns immediately using Form 1040X. Do not delay this. The specialist will prepare the forms for you, but you need to sign them and mail them to the IRS as soon as possible. The processing time for amended returns is currently running 12 to 16 weeks, sometimes longer. The sooner you file, the sooner you get your money back. Remember, the 2021 window closes April 15, 2025. If you're watching this video in early 2026, that window might already be closed. Don't wait another day. File this month if you discover an overpayment. Step 5. Prepare for the 2027 rule changes now, not later. Work with your tax specialist to create a plan for how the new thresholds and calculations will affect you specifically. You might need to adjust your income sources, change your withholding, or restructure how you take retirement account distributions. These planning moves need to happen in 2026 so that when 2027 arrives, you're ready. Don't wait until January 2027 to think about this. By then, it's too late to optimize for that tax year. Start planning now, and you could save thousands in 2027 and every year after. Let me recap what we just covered. Thousands of seniors have been overpaying federal taxes on Social Security benefits for years because of calculation errors and outdated thresholds. The average overpayment is between $700 and $200 per year. You have 3 years from the filing deadline to recover overpayments by filing amended returns. Right now, you can still recover 2023, 2022, and 2021. The 2021 window closes April 15, 2025. Starting in 2027, new rules change the thresholds and calculations, potentially saving you even more if you understand them. You now have information that could save you $2,000 to $5,000 or more in recovered overpayments. Don't waste it. Remember Dorothy from the beginning? After she discovered her $4,247 in overpayments, she filed amended returns and received $2,140 back within 4 months. She called me 3 weeks ago and said it was the best decision she made this year. That money paid for 6 months of her prescriptions, with enough left over for Christmas gifts for her grandchildren. You can do the exact same thing. The only difference between you and Dorothy is that she acted immediately. She didn't wait, she didn't procrastinate, and she didn't assume it was too complicated. She just did it. If this video helped you, here's what I need you to do. First, subscribe to this channel so you don't miss the next urgent update about the 2027 changes. Second, share this with someone you care about, someone who needs this information. Third, leave a comment telling me your state or your situation. I read every comment and I try to respond to as many as possible. Your comment also helps other people find this video. Do all 3 of those things right now while you're thinking about it. One more thing. This video is for educational and informational purposes only. It is not legal advice, financial advice, tax advice, or accounting advice. I'm sharing general information, but every situation is different and laws vary by state. Before you make any decisions based on what you heard here, please consult with licensed professionals like tax attorneys, certified public accountants, or financial advisors who can look at your specific situation. What works for one person may not work for another.